Jay Powell, in a speech before the Economic Club of New York, will say that interest rates are still low by historical standards, and rates, picking up the language from Rich Clarida from yesterday, are, quote, just below the range of neutral estimates. And the path of gradual rate increases has been designed to balance risks. I point out he talks about that in the past. I still think he means it's a present issue. But he does say there's no preset policy path, and the Fed will pay close attention to data. The Fed must take seriously, he says, the risk of moving too fast and moving too slow. On the economy, Powell says the economy is at or near maximum employment and price stability, the two objectives of the Federal Reserve. And the economy is growing above trend, and the Fed is forecasting solid growth, low unemployment, and 2% inflation. Now, this is a speech largely about financial risks, and he mentions three in particular. He mentions one of them being U.S. rate increases as one of the risks out there. Trade disputes is one of them. Brexit and euro area fiscal challenges are another set of challenges. And broadly on asset classes, he says there's no major asset class where valuations are far in excess of historical benchmarks. On equity prices specifically, he says they're consistent with historical benchmarks. This is a new thing for the Fed to be evaluating or publicly disclosing what it evaluates on different asset classes, and he does not see dangerous excesses in the stock market. But he does talk a little bit about the recent volatility. I think this is important. He says, quote, it is important to distinguish between market volatility and events that threaten financial stability. Large sustained declines in equity prices can put downward pressure on spending and confidence, and you can be the judge as to whether or not we've been through one of those. I suggest he's saying not. A couple more things real quick. Valuations, he says, are high for some asset classes, and he mentions specifically corporate debt being at the upper end of valuations, also mentions commercial real estate. But overall, he concludes, as the financial stability report does, that financial stability risks are moderate.